Hello, scholars. My name is Joseph Ejike Oji. The Our topic of discussion tonight is interest rate. And if we have more time in the coming days, we will look at other topics like bonds and stocks. Okay. Now, let us begin. Interest rate is a name that we give to the cost of borrowing money. Now, but interest rate is a relative term. For you, the consumer, it is the cost of borrowing money. But to the lender, which can be a bank or any other financial institution or even private individuals, it represents profit to them. Okay. Now, our understanding of interest rate, their meaning, what causes them to change, and how they relate to the changes in economy is the fundamental importance in the world of finance. As a matter of fact, the world of finance runs on interest rates. So when you buy an item like a car or automobile on credit, you have decided to consume now and pay later. As a matter of fact, interest rates make it possible for people, even the middle class and sometimes the lower class, to enjoy something that they cannot afford to pay in cash now, than waiting for the future to enjoy it in the future. So they can buy it now and pay it little by little until, depending on the number of years they sign on the contract. Another thing is this: when you decide to invest in your education, you expect the future earnings to be larger, making it easier to repay student loan. Now, some businesses borrow money when they want to do a project. For example, suppose a company like Apple want to develop a new iPhone. They might sell bond to reuse it to raise money, and of course, the people that buy the bond will receive a coupon payment, which is basically interest payment, depending on the type of bond. Can be every 6 months or every year. So in fact, interest rates make it possible for people to start business. In fact, it makes the economy grow. Without that interest, nobody is willing to lend you money for a long time, like 10 years, to pay back in 10 years or in 3 years. No, it is because of that interest they will earn, that will give them the incentive to lend you the money, pay back in 5 years. So you can imagine that without interest or interest rates, what will happen to the world economy. So I think I have given you a lot of background on what interest rate is. Now let us proceed to the next thing that relate to interest rates. So in plain terms, interest rate is the amount charged, expressed as a percent of the principal. So the amount charged by a lender, and it is expressed as a percentage of the principal. So what the lender charged the borrower is interest rate. Again, to the borrower, it represents profit. Sorry, to the borrower, it represents the cost of borrowing the money. To the lender, it represents profit. Now, let's look at the things that determine interest rate in the market. The market interest rate. So interest rate is the basic price that equates demand for and supply of loanable funds in the financial markets. So it is the main price that lenders charge for lending money to customers. Now, in figures 1 to 4, in the next slides, I will explain how interest rate is determined in the financial market. According to figure 1, here, you can see figure 1 here. This is it represents the equilibrium. Uh, uh, the equilibrium with the supply of when it comes to the demand and supply of interest rate. So according to that figure, the interest rate R that is shown there clears the market by bringing the demand and supply uh, in equilibrium. You can see it here. I assume as a matter of uh, you know discussion, I just assume that the interest rate is 5%, and I can see the point of equilibrium here. At this price, the quantity of loan lenders are willing to lend this amount of money, and the borrowers are willing to pay this. So lenders want to lend this, I want to lend the money at this price, and then borrowers are willing to, are okay with the price. So there's equilibrium. Now, sometimes equilibrium can be shifted. When it shifts, it might raise the interest rate up, and then other things will start to happen. So in other words, figure one show the interest rate that clear the market, because the market are willing to borrow at that price, and the lenders who have the loanable funds are willing to lend at that price. Okay, so that equilibrium price and that interest bring the demand by borrowers for the funds in equilibrium with the supply by the lenders for the fund. So, like I said, I choose 5% for this. But then, interest rate may move, like I said, move from one equilibrium to the other equilibrium. For example, if there is an increase in the desire to invest in business assets because of when the economy is expanding, especially, that might cause the demand for interest rate to move up from D1 to D2 as shown here. So let's say that the economy is heating up. People want to start business and they want to borrow money to do some projects. That will push the demand for interest up. And when this happens, lenders will start charging more. So that will give us a new equilibrium. Because the supply stays constant, but that's because of the high demand to borrow. That will make lenders to say, okay, these people want to borrow so much. Let us make more profit by increasing the cost of borrowing. So it will move it from 5% to 6%, shown as D1 to D2, because the demand goes from the supply stay the same, but the demand moves forward. Okay, so that's the new equilibrium. So the result, I can say, is showing because that means that the interest rate will go up to 6%. But remember, uh, as higher interest rate becomes available to savers, saving may increase. What does this mean? Sometimes people put money in their account because of the money the interest they will earn. Some banks pay interest on their savings account. Now, sometimes the bank might want you to keep the money there because they lend it out and charge interest on it. So this explains why in some banks, if your savings account is $500 or more, they will stop charging you for keeping even checking accounts. If your checking account is $500 or more, they will start charging you bank fees. But when it goes below 500, they start to charge you bank fees. So they are trying to motivate you to leave the money in the bank so that they can lend it out and make more money. So as an incentive to you, they say, okay, if your money is up to $500 in the account or more, you're not gonna it become a free checking account. So they are trying to motivate you to do that. Now, a decline in business activity will be expected to have the opposite effects. Suppose that businesses are not uh, willing to do more projects. Let's say that some businesses see that this interest rate is too high. Some of them might say, okay, instead of borrowing money at this 6% to do this project, let us postpone this project in the future when the interest rate will be lower. In that case, the interest rate will now shift downwards. Okay, it will go down back to the original equilibrium at 5% because less people are borrowing. So when they feel that the cost of borrowing is high. As a matter of fact, this is why so many people are concerned at this point that we have high inflation, that the cost of borrowing might be higher. So they are concerned that if businesses see this as too high and stop doing more projects, if they stop doing projects, that means there might be a recession, because when business borrow money and do projects, they make more sales, create more jobs, and the economy keep growing. But when the inflation is high and the government want to lower the cost, the inflation, they might start to charge higher interest to banks, and the bank will now shift that higher interest to consumers. That means the cost of borrowing will be high. Let me explain this briefly, in a way that you will understand it better. Now, the bottom line is this: how the bank make money? See, this is the banks. This is the banks. Okay. This is bank, and 1 minute. Suppose this represents a bank. Okay. And this represents Federal Reserve or Central Bank. I call it Central Bank. Okay. Then, and this is the Commercial Bank. Okay. Bank. And then this becomes businesses and individuals. Okay, business and individuals. So we have this, the bank, and then this represents business and individuals. So how banks, maybe bank can borrow money. They borrow money borrow at from central bank, let's say at 1%. See, and then they may lend it out to businesses and individuals at say 3%. Okay, for a profit of 2%. See, so in other words, they borrow from the banks, central banks, and then lend it to us at 3% for a profit of 2%. Sometimes banks might even borrow from their individual bank. Let's say an ordinary bank here. They borrow from this for other banks, usually overnight borrowing at let's say 1%, and lend to us at 3% or 4%. This is how bank makes most of the money. So now when the demand for money is low, so it affects banks. And if for some reason, like what we are having now, that the central bank or the government feel that the inflation is high and they want to curb fight inflation, they might might increase the borrowing cost to say 2%. That means bank will start making less money, 1%. You know what? So the only way they can make more money is to increase the price they charge to customers at 4%. They say 4%. See, that's the only way they can make up to 2%. Now, when they increase it, some businesses and cost individual might say, okay, the cost of borrowing is so high. They will say, okay, let us not, but they will start reducing the amount they borrow. And with this reduction, it means that the businesses cannot start new projects. And when they cannot start new project, they can't create more jobs. And if this continues, it might cause unemployment and recession. So that's why many people are panicking now that we have high inflation, that the cost of borrowing might go up. As a matter of fact, the Fed raised the interest rates recently, last June, and people were very concerned. So now, I think you get the point. Let's see, move back to this, to the my work. So in figure 3, we are shown the unanticipated effect of increase in inflation, which can lead to which can make the lenders or suppliers to require higher interest rate, like I explained a few minutes ago. So now this will mean that supply will shift to from S1 to S3, which for the purpose of this discussion means 7%. So let's say that there's increase in inflation that we have now, okay, and that might cause the demand stay the same. The suppliers we might like to increase or require higher interest, like I explained in my diagram, because the only way they can make money is to increase the add more, charge more, and when they charge more, it might turn off a lot of borrowers. So for illustrative purposes, that means this increase in high interest is shown by S1 to S2, which you can see right here. S1 to S, you can see the price from 5% to 7% because of inflation. Okay, because why? And another reason is that they want to make sure that when you pay them back the money, the purchasing power of that money will still be the same. Because if they borrow, let's say that they borrow that the banks that the banks lend you the money. Give me 1 minute, let me put this together. Okay, I'm going to use this. Suppose that the banks borrow the money at 2% from, let's say 2% from the say maybe Federal Reserve or other banks, and they are supposed to make to lend it at 4% and make a profit of 2%. Maybe that way. Now, but because of inflation is, which is 1%. See, 1%. So that means when you pay them 2%, even though you pay them 2%, what they will actually have in terms of the purchasing power will be 1% if they subtract the effect of inflation. See, so that would make them to even charge more, so that when you pay them that 2%, the purchasing power will be exactly 2%. So you may ask them, okay, because of this inflation, instead of lending you at the money at the price of 4%, they might decide to make it 5%. Okay, 5%, so that when they make their profit, when you pay them, profit now becomes, I'll put the profit under. The profit will now become 2%, 5% minus the cost of borrowing, which is 2%, minus inflation of 1%. Okay, 1%, which is give them the same 2% purchasing power. Otherwise, if they did not factor this, the cost of inflation, then there'll be that means they will lend it at 4%. So that when you subtract this, they will make only 1% from you. See? So in other words, add the cost of inflation, and that means the cost of borrowing will be higher. I'm using this as an illustrative purpose. Inflation of 1% is not that bad, but let's say that it increases by extra 1%. That'll be a problem. So that's what I'm trying to explain in that diagram here. I can see. So they have to charge you more, 7%, so that if they factor in the effect of inflation, they'll still be making profits that have a, you know, purchasing power. Yeah. So in other words, figure 4 that we have here, according to figure 4, it says that it showed a situation whereby borrowers may cut back on their demand for fund because of the increase or unanticipated inflation. Because now when there's inflation, it costs more to borrow on the on the part of the borrowers. So when the blenders increase the cost so that they can cover their make profit, it affects the borrowers, and this is reflected here when borrowers cut down their demand for fund from D1 to D3. See, now inflation caused lenders to move to charge more, which is 7%. See, from S1 to S2. Because of this high cost, people might say, okay, a project that we do this month or this year, let's do it next year when the cost of borrowing will be lower, or when they, so that will bring down demand to D3, which will then force lenders to lower their cost of borrowing to maybe 6%. So what I'm trying to say here is that the equilibrium keeps shifting. If the cost of borrowing is high, it will affect the economy. Less people or less businesses will be borrowing to do projects that will create jobs, which will cause, affect the economy through high unemployment in the long run. Now, but when the cost of borrowing is low, now people can borrow, do more projects, create more jobs, and people, as people get more jobs, they would like to spend. And when these things are going on, with high demand for goods and services, eventually push up price, leading to inflation. Which means, and if it is not controlled, the economy may become overheated. So to control the inflation, there's a price for it. It might cause recession on unemployment. So that means the government and the central bank have to figure out a way to balance these two. Lower the interest rates, create more jobs. They have to find the equilibrium where the balance should be. That there. As a matter of fact, most developed countries, what they do, they say, okay, let us target inflation, make it 2%. So when it goes above 2%, they have to do something to bring it down to 2%. And when they go below 2%, they have to do something to bring it up. Because the low inflation is not good as well. What we call deflation. Deflation means that the low prices are falling. So as a business, if you bought, cost of production is, let's say that inflation is 2%, and the cost of production is 3%. So now, when inflation goes up, when the price keep falling, your cost of producing is 3%, but due to low inflation, the price, what you produced with $2 a unit, the price went down to $1 per unit. So when you sell it, first of all, you can't even sell it at $2 because the price have gone down. Secondly, if you try to sell it at $1, you're selling at a loss. So deflation is also a problem. In other words, government and the Federal Reserve are always trying to balance these two things. Make sure that they maintain a level of inflation that will be sustainable, and that will also help them to maintain an optimal level of economic activity. So there's going to be jobs, and the businesses will be making money, and then creating more jobs, and so on and so forth. So that's what he's trying to explain here. All of these things run on interest. Okay. So now let us look at some historical changes on U.S. interest rates over the years. According to published evidence, interest rate for loanable funds have varied throughout U.S. history. Used to what I just explained, the shifting demand and supply for funds. So, since the Civil War, there have been 4 periods of rising or high interest rates, and 4 periods of falling or low interest rates. The 4th period of high interest rates are as follows: between 1864 and 1873. During that time, there was an increase in economic expansion. The country was growing after the Civil War ended. So that because of that, the growth, high increase in growth, there is a high demand for money to borrow, so that the people can borrow and do projects. So because of that, the cost of borrowing went up, which is the interest rate went up. Now, another period is 1905 to 1920, which in this case, we have high interest rates due to the pre-war expansion and inflation that is associated with World War One. So that caused the interest rate to go up. Now, from 1927 to 1933, that is another period that we have high interest rates. What is the cause? Well, according to the published evidence, it was caused by the economic boom from 1927 to 1929 and the unsettled conditions in the security markets during the early part of the Great Depression, which happened in 1929 to 1933. And the other period is 1956 to 1982. That's another period of high interest rates, high cost of borrowing. Now, after the Second World War, the U.S. experienced a rapid economic expansion. And how do the economy expand? The businesses borrow money to build more, establish more businesses, do more projects, create more jobs. So after the Second World War, there was a high increase in economic expansion. As a matter of fact, because the United States also participated in rebuilding Europe, which was devastated by World War II. So using their Marshall plans, they basically rebuilt Europe. And some of the contract for doing that was awarded to many of the companies that did that job are American companies. So they have to borrow money to finish the project. And inside the US, as a matter of fact, growth was also being experienced. People bought a lot of war bonds during the Second World War. They were encouraged to buy war bonds. And after the Second World War, when they started getting payment from those bonds, they were also spending. People were really doing well after the Second World War in the United States. So that pushed interest rates up. Now, we can now, at this moment, let us look at the some of the 4th period of low interest rates in the United States from 1873 to 1905. Well, this one was caused by that increase in the supply of funds. Supply of money. I mean, if you say fund, when I say fund, I mean money. So, increase in the supply of loanable funds, and this increase in supply, there's more money to lend, but less demand for it. So, the cost of borrowing went down, to attract more borrowers, more businesses to borrow. The lenders lower the interest rate. Another period is 1920 to 1927. This is the main cause here is the rapid growth in supply of funds and falling prices generally. Now from 1933 after the to 1946, so the action taken by the government to fight depression and finance World War II caused the interest rate to go down. So they reduced the cost of borrowing very low, make it very low, so that business can borrow and create jobs. So to fight inflation and also finance World War II. Also remember that during that time, the people, the U.S. government encouraged their citizens to buy bonds. When they buy those bonds, is what it means that they are lending money to U.S. government to finance the war. Uh, to attract them, they charge low interest. But then 1982 to present, the whole almost the whole of civilized advanced countries, mainly Western Europe and the United States, Canada, they have been enjoying a very low interest rate. As a matter of fact, there's some countries where the interest rate was so low that it's almost cost deflation. Country like Japan. So all this time, the interest rate was so low. They're trying to they haven't been this low since 1970s, well, 1760s and 70s. Yeah. So now, from 1982 to the present day, long-term interest rates in the United States have been falling, and of course, it accelerated. Well, when I say accelerated, I mean it fell more in the early 1980s and have reached historically low level. It's only recently that they're trying to increase it, and the increase they made was very slight. You know. Now, the key point to know here is this: today, short-term, long-term interest rates are at historic low in America and even in some European Union countries. So, usually the reason for this is the Fed, which when I say Fed, I mean the central bank. They want to avoid financial meltdown after the 2007-2008 financial crisis. So because of that, they lowered interest rates. The cost of borrowing was so low. As a matter of fact, I can show you a chart on that eventually. Even though they tried to raise it recently, it was only by 1.5% to 1.75%, which is still very low, lower than 2%. So let's see. Let me see if I can show you this. Yeah, I can show you that in a few minutes. Now, let's look at federal fund rate at this point, which is a type of interest rate. We call it federal fund rate because it is an interest rate at which a depository institution like banks lend money to other to Federal Reserve or to other depository institutions. In plain terms, federal fund rate means the interest rates at which banks and other depository institutions lend money to each other. See, usually in overnight basis. So let's say that Bank of America felt like because of high demand for withdrawals this in a weekend, you might say, okay, let me go to Federal Reserve, or let me go to what I call it to Capital One Bank and borrow money from them just for this weekend. The Capital One might say, okay, you want to borrow from me this weekend, so I'm going to charge you 2%. So the Bank of America will now say, okay, 2%, no problem. We will pay it the following day. We call it overnight borrowing. So what happened is that this, let me explain again. All these banks, the same way you have account with the bank, they all have accounts with the central bank, which is also the Federal Reserve in the US. So when they say that this is a commercial bank, this is Bank of America, Bank of America of America. Okay, and this is Capital One Bank. Capital One Bank. So due to the high demand for deposits, I mean for withdrawal in a particular day in Bank of America, and they don't have enough cash to cover those withdrawals, they say, okay, let us borrow from Bank of Capital One Bank. And Capital One Bank has reserve with central bank. So they can say, okay, uh, if the central bank is lending at 1% or 2%, Capital One Bank might say, okay, Bank of America, I'm gonna lend you that money overnight at 4% or 3%. Let's say that it's 4% for a profit of 2%. Bank of America will say, okay, no problem. We take it from you and then we'll pay you back the next day on this. So by through their reserve with the or what they have with the central bank or Federal Reserve, the Capital One Bank can lend Bank of America that money overnight, then make a profit of 2%. Also, Bank of America can go direct to the central bank and borrow that money at 2% without having to pay the high interest rate that for 4% that Capital One may charge them. When they borrow that at 2%, they can lend it at 4% and make even more money than they will make if they get it from Capital One. Because if they get it from Capital One, they will pay in Capital One 4%. And if they lend it at, say, 5%, they will make only 1% profit. But if they go to central bank direct and borrow it at 2%, then they might say, okay, lend it at 5% and make 3% profit. So that's how and it can even be reversed. The next time, it might be that Capital One is the bank that needs money. They can rush to Federal Central Bank, Bank of America, for help to give them overnight loan, and then Bank of America can then charge them. So it happens every time. So that cost or the interest rate that they charge each other is what they call the federal fund rate. Because why? So they get from the Federal Reserve or Central Bank and lend it out to that other bank. So the federal fund rate is one of the most influential interest rate in U.S. economy because it affects monetary and financial conditions, which in turn have a bearing on a key aspect of the broad economy, including unemployment, growth, and inflation. So the higher the federal fund rate, then the more expensive it is to borrow money. So if the Federal Reserve says, okay, I'm lending to the bank at 1%, the bank can borrow that at 1% and lend it at 3%. But if they say, oh, we're going to lend at 2%, that may increase the cost to bank. Bank can borrow at them and lend out at 4%. And that will make the customers say, oh, the cost of borrowing now is very high. So which can have effect on the frequency or the level, the frequency of borrowing, or or the which will affect the frequency of borrowing. It will also affect growth, because companies borrow to invest in a project that will create money and jobs. So because it is only applicable to very creditworthy institutions, and it is for a very short term of an interval. So it's a short term loan. The federal fund rate can be viewed as the base rate that we use to determine the level of other rates in the economy. So let's see. Let me show you what the federal fund rate is so far before the increment that they did. The interest rate hike that the Federal Reserve did last month. We have. So let me see if I can open it for you. All right. See. Let me if you can see this. So you can see the effective federal fund rates. Now, see the rate right here, very low, not even. So it used to be, it was in June, in early June, it was 8.83%. But after the Federal Reserve increased the interest rate in June, last June, it went up to 1.58%, and it has been there since. So banks can borrow at this rate and then add their own rate, maybe 2%. Each bank charge different rates depending on the credit of the customer. If the customer have good credit, they will charge even less, maybe 2.1%. Customers that have bad credit, they might charge you more because of the risk that you might default on the loan. You might charge up to 4%. Now, depending on how good or bad your credit is. Okay. Now, we can now look at one concept that is called the Loanable fund theory. According to the Loanable fund theory, interest rates are a function of supply and demand for loanable fund. So everything we have explained so far is basically a reflection of this theory. So, because the theory focuses on the relative supply and demand of fund during a specified period. So now, the demand and supply of this fund interact to determine the rate and the quantity of fund that flows through the entire financial market. If the supply of fund increases and if the demand is constant, the interest rate will fall because there's too much credit that people can borrow. But if there's an increase in the demand for fund, it will cause the interest rate to go up. I'm going to use the graph to illustrate this. Whatever reason that caused that increase in fund, it might be due to lower cost of borrowing in general, or there's the government budget. Let me use a government deficit, because like I said, no matter what caused the increase in demand or the decrease in demand for money, or the increase in supply or decrease in supply, the effect will be, as I explained a minute ago, that the higher the supply, and if the demand is constant, it will lower the cost of borrowing. But if the demand is higher and the supply is constant, it will increase the cost of borrowing. So let's say that government deficit, that means a budget deficit, is decreasing the supply of loanable fund, which is this is the supply here. So it decreases the supply to S2. See, before that happened, the cost of borrowing was 5%. See, and this is the equilibrium. And this 5%, consumers are willing to borrow as much as $1,200, which can be 1.2 million. For the entire economy, might be 1.2 billion. So, but because government deficit caused the available loanable fund to decrease, then the supply will not decrease from this to this S2. Now that will force the lenders to charge more because demand is constant, but the supply have declined. So they charge more. So causing the cost of borrowing to go up to 6% interest rate. See, so it raises the equilibrium have now been raised to this point now, and when it's raised, and the higher cost of borrowing now costs those who previously are willing to borrow up to $1,200 will now decrease their borrowing to $800. See, now if this thing happens in reverse, they say that the supply of there's a budget surplus and the supply of loanable fund increased and the demand is constant. The opposite of what I just said will happen. Okay. Let me see. Yeah, good, excellent. Now, which leads us to the next thing, the sources of loanable fund. There are two major sources of loanable fund. One is the savings by me and you, the amount of money we save. I'll keep it the bank as savings. The bank use that as money that they lend. So they encourage you to save or to leave money in the bank so that they can make money by lending it out for profit. So the individual may save part of their income as in different form, usually the one you decide to keep and don't want to spend. They call it voluntary savings. Or you can save through contractual savings program, like when you buy whole life or endowment insurance policies, or when you repay mortgage loans. When you repay mortgage loans, you have what they call the home equity, which is almost like a form of savings. So these funds are which are building up large reserve to meet future demand or commitment are available for investment for the banks. Another one is the banking system. That's the other source of renewable funds. It is created by the banking system. So bank and other depository institutions channel savings to borrowers and create deposits, which are also the most widely used form of money in US. Yeah. So the amount you save and the funds that are created by the banking system are the main source of renewable funds. Okay. Now, at this point, we're going to discuss some terms that are associated with interest rates. Some of these terms we have nominal interest rates, default risk premium, inflation premium, rate of interest, maturity risk premium, and liquidity premium. So let's look at this one by one. Nominal interest rate, we use the symbol R for that, and it means the interest rate that we observe in the marketplace. Why do we call it the nominal interest rate? Well, it's called that because it includes both. Well, it is a premium for expected inflation. So it factors in inflation and other risk. So, for example, the nominal interest rate is RR, which means real rate of interest plus inflation premium. That means the effect of effect of inflation, and then the default risk premium. That is the possibility that the borrower might not be able to pay back the money. Call it default risk premium. Now, the rate of interest, that's the RR, simply means, as the name implies, the interest rate on a risk-free financial debt instrument when no inflation is expected. So now, the next concept is inflation premium. Of course, it shows the effect of inflation. So it is basically the average inflation rate that we expect over the life of the instrument. When I say the instrument can be a bond or stock or commercial paper and so on and so forth. Now, the default risk premium, like I explained before, is it shows the compensation that lenders charge just in case that the borrower will not be able to pay back the money. So we call it the default risk premium. So it reflects the application of risk and return principle in finance, that the higher returns are expected for taking on more risk. So if the borrower have bad credit, that means the chance of return, it may not even be a bad credit, but the credit was not perfect. So lenders say, okay, I'm going to charge you a little bit just in case you default. So by the time you default, they have gotten some part of their money back. So that means that I'll explain it with an example. Let's say that this is the lender. Okay, this is the bank, which is the lender. Okay, and this is the borrower. Okay, I'll put it this way. Let me put it this. So this is the Federal Reserve or central bank. Okay, reserve. And this is the bank. Okay, Bank of America. Okay, we call it Bank of America. And this is the customer, the borrower. So the bank borrow from Federal Reserve is charging 1% interest, and the bank borrowed from Federal Reserve at 1%, and then he lends to you, the borrower, if you have good credit, at 3%. Okay, and make a profit of, as a profit of, okay, let's say 2%, because 3 minus 1 is 2%. So you can see it that way. Now, if you have that your credit is not that good, say borrower, local borrower with good credit. Now, for the borrower with bad credit, the reverse is the case. Okay. Now, if you have a borrower with bad credit, or maybe not even bad credit, that the credit is not perfect, the bank will say, okay, I borrow from Bank of America. In order for me to make profit from you, you might not be able to pay me back this month, and I'll lose the I will lose the I'll incur a loss. So I borrow from Bank of America, and I'm going to charge you what we call default risk premium, okay, of, let's say 2%. So instead of lending you at 3%, I'll lend you as 2 plus 3, 5%. 5%. See? So that if you don't default, I'll make more money. 5 minus 1% is 4%, will be 4%. But if you don't pay, or you didn't pay half of it, only half of it, because of the high cost of borrowing, by the time you default it, I have collected at least a significant amount of the money back from you. See? Or if you default, I lose this money. So what that motivate me to lend you this money is to charge you more interest. So add the default premium. Okay, but for somebody who has good credit, they won't charge that amount. So the one that have bad credit, the cost go 2 ways: the default risk premium, and then add it to the interest that we charge to lend you the money. See? Okay. Now I'll take you back to where we are. So that's why the when these things are factored into the nominal interest rate, we have that nominal interest rate now become real rate plus inflation premium plus default risk premium from maturity risk premium, and then a liquidity premium. I will explain the maturity risk premium and liquidity premium in the following next slide. So maturity risk premium simply means that the added return expected by lenders are invested because of the interest rate risk on the instrument. Now, interest rate risk simply means the possibility that of changes of fluctuations in market values of fixed rate debt instruments as market interest rates change over time. So let's say that the interest rate was 1% when I sold I lend the money to you. Now, by the time you reaches the time of maturity, the interest rate have come to 3%. See? So even if you pay me, let's say that I borrow from at 1% and charge you 3%. Even when you pay me back 3%, now I may not be able to, because I have 3%, but the interest rate is now 3%. I can't borrow again and make profit. So I have to borrow at a higher interest rate. And then that means my next customer will have to charge him more. So the interest rate the changes interest rate catches up with me. So in that case, to avoid that, I'll factor it in my charge cost of borrowing to make sure that maybe instead of charging you, when I factor everything in, it might cost me to charge you 6%. So that even if the interest rate goes up by the time you pay me back, I'll still have money to borrow and still make profit and charge more. So it's really a very complicated, simple but complicated issue. Yeah. Now, so in general, we have that the real rate of interest now becomes, you have to factor everything in: the real rate, inflation premium, default risk premium, maturity risk premium, and liquidity premium. Now, let me explain what liquidity premium is. Now, a liquidity premium simply means that is the compensation for those financial debt instruments that cannot be easily converted to cash at prices close to their estimated fair market value. And I will give you an example of that. Now, let's say that you bought a bond, maybe a foreign bond that is not denominated in dollars, but because of the fact that the bond is the country bond is risky, it might not be easily to convert that bond to dollars, because of maybe they're having a currency crisis or something like that. So that makes their bond to be a pariah. So even though you have that bond, but to sell it becomes difficult because people are running away from it. A good example is Russia, which they defaulted last month, I believe. Well, their own default is that they have the money, their bond, Russian bond, they have the money to pay it. But because of the sanction they have, they can't get enough dollar to pay it back. See? So that's the liquidity is affected. And so if a bank is about to lend to Russia money in the future, or if for any country at all that is risky, have that kind of risk, they have to add that extra cost of borrowing to cover the risk that when it's time for them to pay back, their bond may not be as liquid as it was when they when they sold it. Put it that way. So, another example. So that means that a corporation's low quality bond may be traded infrequently. As a consequence, a bondholder who wishes to sell tomorrow will find it difficult to sell except at a large discount price. And that is what is happening to Russia now, due to that they can't get enough dollar to pay back the bondholders. It made a bond to be illiquid. Now, so but there's security we call risk-free securities, like the U.S. Bond is risk-free. British bond is also risk-free. Why are they risk-free? Because they have not defaulted. United States is the risk-free bonds, risk-free securities, like U.S. bond. U.S. always pay their bond. They redeem their bond when it matures. So by combining the real rate of interest and inflation premium, then we have what we call risk-free rate of interest, which in United States represents the U.S. Treasury debt. So again, it is believed that the U.S. is not going to renege on its obligation. So that means that makes their bonds to be risk-free. Now, when it is risk-free, the return is low. The one that have high risk pay more returns. So if you can stomach that and buy a risky bond, like a bond from a country like Brazil, or what they call it, what's the name of this country that have Argentina, it's risky, so they will charge you more. Sorry, they will pay you more interest to attract you to buy their bond. So if you can hold this, be able to stomach the fear of them defaulting and hold it to maturity, you might make money. That is if they did not default. Now, so this is why we view U.S. Treasury security as being risk-free. So because U.S. Treasury securities are risk-free, the default risk premium is assumed to be 0. Maturity risk premium is 0%, and the liquidity premium is also 0%. Okay. Now, let's apply this to some, let's solve some questions on this. Question 1 says, let's assume 2% is the current expectation for a real rate of return. Okay. Let us assume that the nominal interest rate is 4%. Okay. Now, then determine the average inflation expectation of holders or investors in the treasury security. That means basically it's asking you to determine the inflation premium. That means the effect of inflation. The inflation, first of all, the rate of nominal rate is 4%. Okay. Now real rate is 2%. Okay. Then because this is US Treasury, the default risk premium is 0%. Maturity risk premium is 0%. And liquidity premium is 0%. So you plug it into this equation. Inflation premium is R minus RR minus DRP, MRP, and LP. That means 4% minus 2%, minus 0%, minus, because these are risk free. That gives you 2%. So that means that investors will expect 2% inflation rate over the next year. And if they want a real rate of return of 2%, that means they should charge a nominal rate of interest of at least 4%. Okay. Now let's take a quick look at what they called marketable government securities. Well, these are so called because they are securities that can be purchased and sold through customary market channels. So large commercial banks, and security dealers maintain, this kind of buy this kind of securities, and they include bills, notes, and bonds. Now, they call them bill. Basically, they are the same thing. They are all bonds. What made them different is their maturity time or maturity date. This one have a shorter maturity date than this and that. So let's look at their individual maturity dates. So Treasury bills, well, they are issued with the maturities of up to 1 year. So they usually have a maturity date of 91 to 182 days. Now, Treasury notes are also a kind of bond too, a kind of government security that they have a maturity date of 1 to 10 years. Now, then Treasury bonds have a maturity date of 10 to 30 years. I can show you some of this in real life. Suppose you want to buy US bond, you can just go to this what they call Treasury Direct. Okay, let me see. They call it Treasury Direct. It's a website. So you can see for the individual, you can see the Treasury securities. You can see Treasury bills. You can see from here. You can see there are many of them. Treasury bills are sold in terms ranging from days to 52 weeks. See? If you want Treasury notes, this one here, Treasury notes, make sure you're seeing this. Okay. If you want Treasury notes right here, if you click on it, you can see that they have a maturity of 2 years, 3 years, 5 years to 10 years. And if you want the Treasury bonds, they have a maturity of 20 years to 30 years. There is even the one that's called century bond. Now, you might ask yourself, why am I buying something that will mature in 20 years, 30 years? So do I have to wait? Well, you have to wait, but you make money. How do I make money? They be paying you the interest rate. I call it coupon payment every 6 months. So so that when it matures, they'll give you your money back, the whole money back, plus another coupon payment. So maybe I should use illustration. Let's say that you buy this bond. Suppose you bought. Let's say that this is the bond of $20,000. Okay, and the coupon is bond. Okay, let me make this a little bit big. And the coupon rate. Now, what they call it coupon rate? Well, in those days, before they have the computers and before the age of computers. People that own bond, they send you what they call it bond certificate. There's a coupon that's attached to it. So you tear it out, fill it up, fill it every 6 months, fill it, and then mail it for payment. So that's why they call it the rate they put on that coupon. They call it coupon rate. The coupon rate is 5%, which is 0.05, and this is a 5-year bond. Okay, let's call it that, 5-year bond. So this is the coupon rate. So that means that every 6 months coupon payment that you receive will now become equals 20,000 times 5%, $1,000. So that, which means that every 6 months you receive $1,000 payment. Every 6 months, $1,000 payment until 5 years. Then when the 5 years reaches, they'll pay you back your $20,000 plus another coupon payment. So you're not losing either way. So that's why people buy it. Yeah, as a matter of fact, there's an investment, there's a bond that we call a century bond. That when you buy it, it's for 100 years. You will not, so they will pay you coupon payment for 100 years. Of course, you may not live for 100 years. You might die before 100 years, and then they will pay it to your beneficiaries. Okay. So now so that's what treasury. So like I was explaining, the difference between the three of these, they are all bonds, so that the maturities are different. This one is weeks. This one is a year to 10 years. This one is 1 to 5 years. This one then 10 years. This one will be 10 to 20 years, 30 years. That's the only difference between them. Now let's look at question 2. According to question 2, it says that let's assume that the nominal interest rate on a 10-year treasury bond is 5%. Let's further assume that the investors expect the inflation rate will average 2% over the next 10 years. And they expect the real rate of return to be 2% annually. Find the maturity risk premium. So let me write this down, then we can put it together. So you can say that the nominal rate R, small r, is 5%. Then the inflation premium IP is 2%. Real rate, okay, is also 2% according to the equation. The default risk premium is, because this is I think it's a treasury bond. It's a treasury bond, so it doesn't have any defaults. So the default risk is 0%. And liquidity premium is also 0% because it is a treasury bond. So now let us put this in a, and then calculate it asks us to calculate the liquidity, the maturity risk premium. So nominal rate of interest is 5%. Inflation premium is 2%. Okay. The 5% is 0.05. Sorry, 0.02. Then rate of return, sorry, real rate become 0.02 again. Real rate of interest. Then we have, so the default risk premium, because this is US bond, so it's 0%. Treasury. Then liquidity premium is 0%. So the question asks us to find the maturity risk premium. So the formula is this: the nominal rate minus real rate of interest minus inflation premium minus default risk premium minus liquidity premium. So if you want to do it in Excel, you can just once you have it, just equals, we have this minus this minus Okay, all of them minus that. So that will give us, of course, all these are percent. You can just change it to percent, 1%, which you can see in our PowerPoint presentations, 1%. So what does it mean? It means that holders or investors will require a 1% maturity risk premium to compensate them just in case there's a possibility that of volatility in the price of the treasury bill by the time 10 years reaches. Okay. At this point, we'll make just a brief explanation of what inflation is. I hope you are not tired by now. I hope you are enjoying this. So, while inflation in a layman's language simply means a general increase in price and a fall in the purchasing power of money. So, the two major types, we have the cost push inflation. In this case, under the cost push inflation, it happens when there is a general increase in the cost of the factors of production. When I say factors of production, I mean labor, land, then cost, raw materials and inputs. When those things, those costs rises, then what the businesses do is they move the cost to the price of the goods and services they provide. That means making it to be high. So when the cost of production rise in general, economy-wide, it can lead to increased consumer prices through the whole economy because the businesses will systematically pass on their increased costs to consumers. So we call it cost push inflation because of that. The other one is demand pull inflation. So this one occurs when there's excessive demand for goods and services in the economy. So usually when the economy in a period of expansion can cause inflation because people have money and they want to spend it. So so now because of that, high demand, price goes up. A good example is what happened recently. The current one we are facing, of course, is a combination of two factors. Large amount of stimulus payments due to COVID-19. So the country wasn't, they don't want the government did not want the country to go into a recession because of COVID-19 pandemic. So everywhere was locked down. So people don't have jobs. People, when they don't have jobs, they don't spend money. And if they don't spend money, businesses won't make sales. And when they don't make sales, they don't hire. Then that means if they don't hire, people will lose their job. And when they lose their job, they're even more scared of spending money. At a point, the whole economy will freeze. People will start, all kinds of things start happening. Businesses will start falling, going bankrupt. It will really be a very crazy situation. So to avoid that, the United States government started paying people who lost their job what they call stimulus payments. So that means they still maintain their standard of living. Now, but then so much money was paid, not only in US, even in European Union. So that means even though the people there's a lockdown, people still have high purchasing power. They are spending. So because there's a lockdown, there was less production. Many of the supply chains were disrupted. The inputs are not coming in as they used to come in. So there became a kind of a surplus, too much money chasing too few goods. And the price started to rise. Little by little. Then, on top of that, the Ukrainian between Ukraine and Russia, which made the cost of oil and gas to go up. Therefore, even increasing the cost of input. And then, with that, these two factors now, the demand and the cost now push the prices up. That's why we're having up to 8% inflation now. Anyway, I think you get the point. Now, having explained that, then we can now see see how inflation is factored in when we want to calculate the nominal interest, annual interest, nominal interest rates, and the effective rate. Now let's look at a few concepts before we start doing our calculations on this. Okay, let's see. Now, generally speaking, the nominal annual rate is the interest rate before inflation is taken into account. Sometimes we call it the annualized percentage rate, or what we call APR. So generally speaking, nominal rate equals real rate of interest plus inflation rate. But like I said, the nominal annual rate is different because it is the interest rate before factoring in the effect of inflation. Now, if there are more frequent compounding, you use what you call, if you need more frequent compounding, like if it's something like this paid every month, like credit card or car notes, then you need what you call periodic rate of interest. So this is the rate charged by lender or the rate that are paid by borrowers during each period, for each period. So the formula we use to calculate it is I over NY, where I represent the nominal interest rate and M represent the number of periods. Okay, let's try an example of this. It says for 6% nominal rates with semi-annual payments, the periodic rate is computed as follows. You just to divide 6% by 2. Okay, it says semi-annual, so that means it is paid 2 times in a year. So that means the periodic rate will now become that amount, the interest rate divided by 2, that gives us 3%. Okay. Then there's another one that we call the effective rate, call it effective annual rate. Sometimes we call it annual effective yield. So a simple way to explain this is that it is the true opportunity cost measure of the interest rate, as it considers the effect of periodic compounding. Now, the formula we use for calculating that is this one here. Effective annual rate equals 1 plus the nominal rate divided by number of periods raised to the power of number of periods minus 1. So key point about this rate, because the annual percentage rate misstate the true interest rate, the effective rate is used as a better measure because it factors in the excuse me, the disadvantage, or what I call the what make the APR less reliable, or the shortcoming of APR, the effective rates take care of that. So because it is the true opportunity cost measure of the interest rate, as it considers the effect of periodic compounding. I'll give you an example of what I mean by that. Let's say that the unpaid balance here credit card is $100. Okay, and that the interest rate is 1.5% per month. So if it wasn't paid, then they factor in this 1.5% on $100. I'm gonna take it to where I can put it here. Okay. Okay, let's see. So this is the amount, $100, right? Amount credit card. Okay. Okay, it's $100. Let me put this is $100. Okay, yeah. And then interest rate. Interest rate is for the month is 5%. Okay, and now this is 5% that was charged. 5% interest of 5%. With 5%. 1.5. It's not 5%. I think it's 1.5% a month. 1.5% per month, which is 0.0115%. So that means balance. If it wasn't paid, balance will now become equals, of course, 1 point, the base is 100, so 1.1 plus, okay, 0.015% times the $100. You give you $101.50. Now this will not, this amount that was not paid will be I'll say capitalized. That means it will be added to this $100. So when next month comes, the interest will not be charged on $100. It will be charged on $101.50. See? So yeah, because a credit card, you pay the minimum payment a month. You don't pay everything that month. That means there's still a balance unpaid. Now this will be capital. This interest will be capitalized. So your balance now is no longer 1,000. Interest will not be charged on the original amount. It will be charged on this. Because if they charge interest on the original amount, it will only cost 1.5%, right? If you charge interest on this, it costs let's say if you charge interest on this, let's say next month, interest have already charged on this. They say next month you have equal, of course, interest will be this, okay, times $100. Now, for this, the interest in charge on this one, the next month to be this times 101.5. You start to pay, you pay extra more on this. I mean, it might look like a small amount here because we are dealing with only $100. If it's a big amount like $10,000, you see that the change, because interest is not charged on $101.50, not on $100. And next month, if you don't pay it, the balance will go up again, and that will become a new balance. See, so that's what the effective rate, because the other rate does not factor in this capitalization of the interest, the previous unpaid balance interest. Lenders tend to use the effective rate because it takes care of that. So it takes care of, or it factors in or measure in the effect of periodic compounding. Okay. Now let's another formula. This formula that I explained that we used to calculate it. This one here, it can be written as follows. As a modified form of it can be this one here. Effective annual rate 1 plus r to the power m as 1. Where r can be r is the rate of interest, but it shows the effect of, together r, the actual interest will charge. You divide that in the original annual interest by the number of compoundment in a year. Okay. So that means we divide what they call the APR, annual percentage rate, by m, which is number of compounding, and then use it to represent the number r. Okay. Now let us look at this example. It says, find the true annual interest cost of credit card that advertises 18% annual percentage rate. So this is an APR 18%. So what is the true cost? So we say find the true annual interest cost, because now if you use APR at 18%, that means the cost that you paid is 18%. But because the effective annual rate, we factor in effect of periodic compounding that I just explained in a few slides ago. That means that you actually pay a little bit higher rate than 18%, because if there's an unpaid balance, it will be capitalized, and the new balance will not contain that, will become a little bit higher than the previous balance. So that's what they ask you this: find the true annual interest cost of a credit card that advertises 18% APR. So using this formula, let me write the formula down and the numbers down. So we have the APR is 18%. The number of, it says annual. So if it is annually, it's compounded annually. That means 12 months. So M is 12. Okay. Now we can now go and type it in to calculate the effective rate, effective annual rate. So we have, when we go into here, I'll take it to so have it here. So I put it right here. Okay. Actually, there are two ways we can do this. We can use the formula method and we can use Excel method. Let's use the formula method first. Nominal rate is 18%, 0.18. Okay. Number of periods. As a matter of fact, yeah, this is okay. Annual rate. Well, okay. Let me see. I think this one will be better for us. Okay, maybe this. So you have effective 18%, which is 0.18. Number of period is 12, because 12 months in a year, so you calculate 12 times. So let's get the periodic rate first. Remember, the periodic rate is nominal rate divided by number of periods. So you have nominal rate, which is equals this divided by 12, which is number of periods. So this becomes our R, which means that you can either use this formula or this one. So one is just a part of the formula. As you can see here, one is a part of the formula. See, so that effective annual rate equals you see, if you want to use this, use it because we already have this part. Let's use this one here. Equals, okay, 1 plus R. Now R is right here. Close it. Raised to the power. The cap. This is means raised to the power M. M is 12. Close it. Okay. Minus 1. So minus 1. And that gives us this, which is if you change this to percent, you see it's 20%, but make it to decimal place, include decimal. 19.56% we have here. If you change this percent, 18%. So when you go to our so that means the effective annual rate is 19.56%. See, it's a little bit higher than the annual percentage rate, and this is the one that most lenders use, effective annual rate, because it takes factor in the effect of frequent compounding. Now going back, I will show you how you can do this using Excel. The same method simply means type in effect, nominal rate, and the rate of rate per year. Before I do that, I want to show you the result we have. 19.56% is also what I have in Excel here. 19.56%. And then if we want to decide to do it or do this work with Excel, you can do the same question. Just use the formula, type in effect. Remember to put the equal sign first. Then click on the nominal rate and number of period per year. So let's do it. So our nominal rate, let's say this is the formula Excel method. I'll call it Excel method. Excel method. So nominal rate is 18%, which is 0.15. Sorry, 118, that's 18%. Number of period is 12 months in a year. So the effective annual rate equals effect, parenthesis, See, nominal rate is right here is 18%, comma. Our number of periods per year is 12. And when you close it, you get, and then close the parenthesis, press the enter key, you get 19.56%. The same thing we have before. Say 19.56%, the same thing. So I've shown you how to do it using both methods. Okay, 19.56%, and you can see it also in my presentation here, PowerPoint presentation. So I've given you a good background on interest rates. In the coming lectures, we'll be looking at bond and stocks. Okay, bond and stocks. I hope you enjoyed our discussion tonight. Thank you for listening, and I hope to see you in my next lectures. Good night.